There's a tax treaty between the UK and the Philippines that's supposed to stop your pension being taxed twice. But here's what nobody tells you. For UK pensioners living in the Philippines, that treaty is practically worthless. And here's the bigger secret. Most UK pensioners here are overpaying tax to HMRC every single year without even realising it. In this video, I'll show you why the treaty doesn't actually work, how much you're probably overpaying, and exactly how to get your money back from HMRC. If you're a UK pensioner here in the Philippines already, or planning to retire here, this could easily put hundreds of pounds back in your pocket every year. And should you wish, you can download your very own copy of the UK-Philippines Double Taxation Agreement. I've put a link in the description below. My name's Andrew, and I believe in straightforward advice for living abroad stripped back to basics, hence Naked Expat. No fluff, no fantasy, just the reality of expat life. And I've been in expat for over 20 years. I'm a UK citizen living here in the Philippines, and I make videos about the practical side of moving overseas, the tax issues, the visa complications, the financial traps most people forget to mention. My most watched video has already helped over 95,000 people understand what happens to their UK state pension when they move abroad. Today we're going deeper into the tax side that catches expats completely off guard. If it's your first time here, please like and subscribe because I talk about all the things that affect your wallet, not just your wanderlust. Let's start with what you've probably been told. The UK and the Philippines have a Double Taxation Agreement, or DTA, first signed in 1976 and updated in 1997. Article 17 of that treaty specifically states that private and occupational pensions should be taxed only in your country of residence. So, if you're resident in the Philippines, your UK personal pensions, not your state pension, should be taxed here in the Philippines, not in the UK. That sounds perfect, right? You live in the Philippines, so the Philippines taxes your pension, and HMRC leaves you alone. Except that's not what actually happens. Here's the reality nobody talks about until you're already stuck in it. The Philippines does not tax foreign pensions for non-citizens. The BIR, the Bureau of Internal Revenue, has no system, no mechanism, and no incentive to tax your UK pension. If you're a non-resident alien receiving a foreign pension here in the Philippines, it's not subject to Philippine income tax. The BIR only taxes Philippines-sourced income for non-residents. So if you were to go to the BIR asking for a Certificate of Tax Residency, that's the document HMRC back in the UK requires to stop taxing your pension income, the BIR will refuse to issue it. Why? Because the BIR are not taxing your pension, so they won't certify that they have the right to tax it. And without that certificate, HMRC won't issue you with an NT code, or no tax code, which means your pension providers will keep deducting tax at source. So you're trapped in bureaucracy. HMRC says, get proof that you're taxed in the Philippines. The BIR, the Bureau of Internal Revenue in the Philippines, says, well, we don't tax it. You stay in the UK tax system forever. So the treaty exists on paper, but it fails in practice. Article 17 gives the Philippines the right to tax, but the BIR won't exercise that right. And HMRC won't stop taxing you without the certificate. To see how this hits your wallet, you need to know how the UK treats two types of pensions. Firstly, your UK state pension. Now, your UK state pension is paid gross. No tax is deducted at source. For 2024-25, The full amount of state pension is £11,502 per year if you've got the full 35 years of NI contributions. But gross does not mean tax-free. It just means HMRC hasn't taken any tax yet. It's still technically taxable income. Secondly, your private or workplace pensions. These include SIPs, self-invested personal pension plans, bulk standard personal pension plans, and workplace pensions and occupational schemes. They're paid net of tax. Your provider automatically deducts 20% basic rate tax before paying you. Now, if you're a higher rate taxpayer, things get a little bit more complex. Even though your pension provider deducts 20%, you still owe the difference, another 20% or 25% through self-assessment. The 2024-2025 tax bands for the basic rate of 20% is up to £50,270 per annum. The higher rate, that's 40% over £50,270, and an additional rate, 45%, over £125,140. For this video, we'll stick with basic rate taxpayers. That's where the overpayment trap lives. Here's the catch. HMRC applies your personal allowance, currently £12,570, to your state pension first. Your £11,502 state pension eats up most of that allowance, leaving only £1,068 in unused allowance. Then your private pensions or occupational schemes are assigned a BR code. That stands for basic rate. It means tax the whole thing at 20%, no allowance. So your pension providers deduct 20% on everything, even though you still had a little bit of unused allowance. As a side note, always check your tax code on your relevant personal pensions and make sure you see a BR code. Otherwise, you might even be overpaying more. Now, here's an example. You receive state pension of £11,502 gross. You've got an additional personal pension or private pension of £5,000 a year extra. So your total income is £16,502. What's actually deducted? Well, private pension at basic rate. Your provider will say, okay, you've got £5,000 a year personal pension income coming in. So we're going to deduct 20% from that. You pay £1,000 a year in tax. Tax deducted, £1,000. What you should owe, your income is £16,502. Your personal allowance is £12,570, which makes a taxable amount of £3,932. The tax owed at 20% on that is £786.40. But you were deducted £1,000. Your tax owed was actually only £786.40, which means you overpaid £213.60. That's £213 every single year that HMRC keeps, unless you reclaim it. Over 5 years, that's over £1,000 gone for nothing. You've got two ways to fix this. You can file a self-assessment tax return, declare your pensions and claim your refund. HMRC usually pays within a few weeks if you file online. Or secondly, use form R53, which is a form for claiming your repayment of tax if you live abroad. You can download it from gov.uk website, fill it out and post it to HMRC, and your refund goes directly into your bank account. You can go back up to 4 years to reclaim what's yours, but don't wait too long. Interestingly, because of the triple lock system and the fact that although we don't know yet and we have to wait for the autumn budget in late November to see the actual figures of what's going to happen, it is likely that the personal allowance for next year, 2026, might well be frozen at the current rate, which means your basic state pension under the triple lock will be higher than your personal allowance. So technically, every pensioner is going to owe a little bit more every year, but we'll have to just wait and see. But for the time being, you've probably paid too much tax unless you've got additional income. But if you've got state pension and personal pensions and no other form of income, you've probably paid too much tax, which means you can reclaim this year and the last 4 years. So if you don't, you'll lose it. As I've already said, if you have multiple private pensions, HMRC sometimes assigns you the wrong tax code to either one or multiple of your pensions. That can mean even more tax deducted than necessary. Always check your coding notices. If you see BR where it shouldn't be, call HMRC. Ask them to reassign your personal allowance properly. They might even refund the difference automatically. Now, just to be clear, this isn't tax evasion and it's not a loophole. It's HMRC's own system causing expats to overpay because the treaty doesn't function in practice. You're following the rules. You're just paying more than you should. And you have every right to claim that money back. Until the HMRC, and more likely the BIR, modernise their systems, which is highly unlikely, this problem will keep catching British pensioners across the Philippines. So take control. Understand the system because nobody else is going to fix it for you. If this video helped you, hit like, subscribe and share it with other UK expats who could be losing money to HMRC. It's not just relevant to the Philippines, it's all UK expats that are receiving simply basic state pension and maybe a little bit smaller personal occupational pension scheme. Your chances are you've paid too much tax and you can reclaim the last 4 years. And for those of you who want more, please consider joining the Naked Expat channel as a channel member, because members get early access to some of my videos, exclusive discounts on wealth and estate planning, one-on-one mentoring sessions, and soon a weekly live stream just for members. Click the join button below to become part of the Naked Expat community. Smart, informed expats helping each other live better lives overseas. Thanks for watching, and remember, just because there's a treaty doesn't mean it actually works for you. Download your full copy of the UK-Philippines Tax Treaty in the description below. Thank you for watching. Until next time, enjoy.